of the biggest takeovers since the financial crisis announced in 10 months. How is this going to shape the Morgan Stanley of 2030 in the next 10 years?
Well, one thing is, Sonali, I won't be here to answer that question, so I'm doing it on behalf of the people who will succeed me. But listen, this has been a 10-year strategy to take what is an extraordinary investment bank and trading business, clean that up in terms of the risk management of that business, take away the prop trading, use that capital more effectively, and it's doing unbelievably well. And then we had to pivot to build up the wealth management business, which we did first through Smith Barney, and then Solium, and then E-Trade, which gave us the digital platform. And now we're doing it on the asset management side, which we did with Mesa West a couple of years ago, very small boutique on the West Coast of the US, and now excitingly with Eaton Vance. So we think for 2030 specifically, you'll find a very stable, faster growing, very fee-based institution, well-capitalized, strong liquidity.
Now, James, explain to me the strategy here. Now, are you making Morgan Stanley for the masses? Are you trying to be all things to everybody now that you've added this large brokerage and this massive asset manager?
Well, no, not at all. I mean, we've done many deals since I've been CEO. We sold oil storage and oil transportation businesses, Hadamar and Transmontane. We sold mortgage servicing businesses, Saxon. We sold European private banks. We sold a business called Quilter in the UK, Azores in Spain, and so on and so on. So we've been reshaping the portfolio. This is about originating, distributing, and managing capital for individuals, institutions, and governments around the world. That's what we do. So being in the asset management space, in the wealth management space, in the trading space, the underwriting space is all consistent. It's all part of that process of originating, managing, distributing capital. So frankly, I think we're a more focused company, certainly than most of the peer set that we deal with.
Now, James, this has been an expensive deal also, but at the end of the day, it's what this deal will deliver to shareholders in the future. It all comes down to profit, about margin. How do you explain the economics to them in the longer term?
Well, I've met a lot of people who want to buy great companies cheaply, and they end up not buying anything. And hopefully you don't buy underperforming companies with a lot of money. If you're going to buy a great asset, listen, Eaton Vance has been around for over 90 years. World-class, huge talent, perfectly complementary businesses. There'll be very little dislocation, high growth, some great businesses with Parametrics in particular has been growing very fast. Their traditional asset management space, the Calvert funds in sustainability. So this was a no-brainer. We paid full dollar for it. I make no bones about that. But that's what you have to do if you want to buy high-quality businesses. And they came to us. They wanted to be part of the Morgan Stanley business, and our cultures align. Listen, it's mildly accretive day one. It used up about 100 basis points of CET1, which is our core regulatory capital ratio, but we've accreted about 100 basis points this year. So we're sort of back to neutral. So it's going to be a terrific deal over the long run. I'm not worried about the financials at all.